Well, hello, and thanks for tuning in to the newest Whitley Penn podcast episode. We're going to be focusing today on myth busting and talking about some common myths around accounting and taxes. And I'll start off with introducing myself. My name is Judd Campbell, and I'm a tax partner in our Whitley Penn Odessa office. I have been with Whitley Penn and a predecessor firm for about 14 years and practice in oil and gas related industries. So certainly some E&P businesses, but also a lot of service businesses here in the Permian Basin and the oil field. And so today with me is Katherine, Kirk, and Breanna Oakley, who are senior managers in our Odessa and Hobbs offices. So I will turn it over, let them give a quick introduction of themselves.
Hi, my name is Katherine Kirk. I'm a tax senior manager in Odessa. Fun fact, I'm a third generation CPA. So doing accounting and taxes runs in my bloodline. I've been here for 15 years and help take care of clients in all kinds of industries. Obviously, a lot of oil and gas related, being in the Permian Basin, but we do medical and service business and retail and wholesale and a whole gamut of business types, as well as individuals and their needs. So we hear a lot of common questions that we're hoping to help answer and get some more information out there for everybody.
My name is Breanna Oakley, and I'm in the Hobbs office. I've been doing this for just about 10 years now. I actually specialize in the agriculture niche for the firm. However, my service lines that I serve are not limited to ag. Again, being part of that Permian Basin group, I also have clients in that realm as well, and also in the medical niche. But really glad to be here today and help debunk some of these myths.
We've put together a list of a few things some questions that we get from clients and from others that, some things that might be confusing or some misunderstandings about the tax law or about accounting in general. And so our plan is just to kind of go through those, discuss maybe why that may be a myth and what the truth behind that is. So we'll start off with maybe something a little basic and straightforward, but something that a lot of people have a question about is thinking that they can't afford to have a CPA. When you hear that, Katherine, what do you think?
Well, I think that that's a misconception. Hiring a CPA is going to be an additional cost. Our services are not for free, but there's a lot of benefits we can provide. Specifically from the tax side, there are tax law changes every single year. Even if Congress doesn't pass a new change, there are things that expire. There are things that have where the rates are going to change from year 1 to year 5 to year 10 of something that's already been in place. And we keep track of that. We do CPEs on that. We know what all of those rules are for this year, for next year, and we can help our clients not have any surprises and plan accordingly. There are sometimes cases where there's a deduction that's available, and when a new client comes to us, we look over their prior returns and realize they haven't been taking all the available deductions. They've been paying more tax than they had to. So there can be a case where we might save you $2,000 in tax in exchange for a $1,000 accounting fee, and you actually made money by going to an advisor and getting it as accurate as possible. We can also give you the peace of mind that your return was done correctly. If you are ever selected for IRS audit or you get a notice, there's someone you can reach out to help guide you through that process. We can interact with the IRS. We can write a response letter to the notice. You're not flying solo. So those are just a few of the ways that we can help from the tax side, as well as lots of other services, advising, entity structures, selling your business, buying your business. There's a lot of other services that firms like Whitley Penn can provide beyond even just a tax return.
Yeah, a lot of times I think it comes down to maybe you don't know what you don't know. And So going to somebody that does know can help guide you to things, and that can pay off. So let's go to something else that a little more on the technical side, and kind of get into the meat of some things. A common thing we might hear from time to time is, especially with the new changes in the tax law, with the stimulus package, and in particular, the new child tax credits that are coming. What is the tax impact of that? Am I going to have to pay taxes on those child tax credits that I'm receiving?
Well, I can chime in on that, Judd. First off, the stimulus checks that have been distributed, in 2020 due to the pandemic, and even in 2021, those are not taxable to you at all. And even if they base those stimulus payments off of your 2018 or 2019 filing. And then for the third round, if 2020 was available, they based it off of 2020. Some people saw record low years in 2020. And so they qualified just only in 2020, and so they actually got the stimulus payments. However, in 21, you don't have to pick that as income. And in fact, if you are actually eligible and you're below the income threshold in 21, but you weren't below the income threshold prior to 2021, you'll also get to pick up what you didn't get for the stimulus check that was cut in 21. Really, it's just a win-win if you qualify. There is no tax implication. There's no payback method, nothing. So really, if you didn't get it and you haven't, and Congress and the IRS, they're still issuing checks all the way through the end of this year. But if you didn't get it because you didn't qualify off of your 18, 19, or 20 income, and your 2021 income took a pretty, a dip, there's a chance you can get whatever you didn't get prior. And then that famous child tax credit, they really just expanded on the existing child tax credit. So they actually bumped it up by $1,000 for some and $1,600 for others. So prior to 2021, that credit was $2,000 for qualifying dependents under the ages of 17. Well, now they have it kind of split up between, well, if you're under 6, you get $3,600, and if you're between 6 and 17, you get $3,000. And they base those off of your 2021's income. Well, everything's circulating right now because people have started collecting the advanced monthly payments. And those advanced monthly payments are exactly what they are. They are advancements of the 2021 credit. And how do they calculate whether you are going to get the credit on your 2021 return? Well, theoretically, they're using your 19 or your 2020 tax filing to determine eligibility if you deserve those credits in advance, okay? And, a lot of the questions that we're getting is, should I not be accepting them? Am I going to have to include this as taxable and whatnot? But first off, no, it's not taxable to you. It's an income tax credit, okay? However, if your income takes a pretty big spike up in 2021, there is chance of repayment of anything you were advanced in 2020 or 2021, actually advanced in 2021. You might have to repay that with the filing of your 21 tax return. What's the likelihood of that? I mean, realistically, if you're 18, 19, and 20 returns, you qualified based off those. I mean, your income tax situation doesn't go drastically up and down. Most Americans are pretty steady each year. So if you started getting those advanced payments because you qualified on a previous tax filing and you don't suspect 2021 to be a big bump in income year, then you're probably not going to have to repay any of those advanced payments back, and you'll still be able to qualify for the other half of the child tax credit. So I do like to remind people, there's a lot of fear by getting these payments today of repayment when you file your return. The likelihood is only for those who really saw a big spike in income in 21.
I will add, Breanna, that extra, where it's $3,000 per child if they're 7 to 17, or if it's $3,600 for children 0 to 6. That is for joint couples with income of $151,000 or less. If your joint income, this is for a married couple, is over $151,000 up to $400,000, you still get the old $2,000 per child credit. So there are some people that their credits are going to be the same they've been in the past. There are some people that it's going to go up depending on your income level. So that can be something to look at your prior return and see what your income is, look at your salary this year and compare that to see if you're getting the new larger credits or if you're staying at the older credits.
And the thought behind that too is if you were advanced $300 today and you only qualified for the older $2,000 credit, what that means is the amounts that you were advanced are going to offset what you were entitled to. So for many, they still, if they don't get the additional bump, the additional $1,000 or $1,600 per qualifying kid, but they get the $2,000 amount, but they also collected advanced credits. For many that are going to fall into that category, there's still going to be a small residual credit balance left to claim against the tax liability on your return.
So Judd, talking about child tax credits brings up another common question or myth that we hear, that lots of people believe a deduction is always better than a credit. Can you kind of give some examples and explain the differences in a tax deduction compared to a tax credit?
Thanks, Katherine. That's a great question, and something that can be confusing is the differences between deductions and credits. And sometimes we kind of throw those terms around as though they're similar or even the same. And certainly there are some similarities. They're both benefits. A deduction and a credit is going to decrease the amount that you're going to pay in tax, but the specifics of how those work can be very different. And to start to explain that, it's important to understand how your income tax is calculated. And so the tax is calculated based on what your taxable income is. So if you have taxable income, and just using some examples, just some dollar amounts, and as I've heard others say, we can talk about dollar amounts and then you can add as many zeros to these dollars as you need to for it to be relevant for you. But let's say your income for the year is $1,000 and your tax rate, and this is oversimplifying it, but for the purpose of this discussion, we'll say your tax rate is 20%. So that means that on that $1,000, you would pay $200 in tax, 20% of $1,000. What a deduction does is it decreases that taxable income, so that if you were to take a $100 deduction from $1,000, now your taxable income is $900, and you would apply your 20% tax rate to that $900. And now instead of $200 in tax, you're only paying $180 in tax. So it's a $100 deduction, but that saves you $20 in actual tax paid. A credit, on the other hand, actually goes directly against that tax amount. So if, let's say, you have a credit available to you of $50, then your taxable income would still be $1,000, and you would take that $1,000 times 20%, and you would have $200 in tax. But then you could apply, again, just for the sake of the example, a $50 tax credit, which would reduce that from $200 to $150. So in that case, a $50 tax credit is significantly better than a $100 tax deduction, because the credit actually reduces dollar for dollar the amount of tax. Does that help, Katherine?
I believe so. Kind of staying on that topic, we will also have some people who believe paying tax is always bad. and they really want to push the envelope, get as many deductions as possible so that they have as low of a tax bill as possible. Is that something you would recommend, or is there ever a time that doesn't fit?
Yeah, that's something that comes up often, right? We're thinking about taxes and we want to pay as little as we can in taxes. So we're always thinking about ways to reduce that tax bill. And so finding things that we can get deductions for is very attractive. But like in that previous example, it's important to recognize that deductions only reduce your tax paid by the amount of your tax rate. So if you're looking to spend some money on a deductible expense, again, in that previous example, if you wanted to go spend another $100 to save tax money, recognizing that you're going to spend $100 in order to save $20 in tax, you're still out. At the end of the day, it's still an $80 expense for you. You're out that money. And something that I try to remind clients when we're looking at deductions and how they can lower their tax bill is that what we want to do is make sure that the expenses that you're incurring are beneficial for the business. They're gonna be good business expenses, and we want to make sure that we're capturing all of those expenses in a way that we're getting all of the deductions that are due to you. So anything that you're spending that are qualified, we want to make sure that we're getting all of those deductions, but be real careful about spending additional money just in order to get a tax deduction, because that's often going to be a losing scenario in your bank account at the end of the day.
I do want to add to that with retirement accounts. So sometimes, people shy away from making a contribution into their retirement account because it is an additional cash outflow. I mean, it doesn't reduce your tax dollar for dollar. I mean, as Judd's talked about, it's a deduction. And so it's just the rate of your tax rate, okay? However, keep in mind that for most people, what they're earning during their working lives typically is greater than what they're earning in their retirement age. And so the idea is you're going to get a permanent tax savings potentially in making that retirement contribution today. And in addition to that, over time, hopefully the gains on that investment into that retirement account far surpass the amount you initially put into your retirement account. So I don't, cash is king, but that is one that I truly do believe if you have the cash to do it, and it might put you a little out of your comfort zone because it is still more cash when you file that return or during the year if you do it through your employer, it will pay off in the long run. And there is potential permanent tax savings. And if you have an employer who's willing to match, I mean, you should at least do at minimum of what they can match. I mean, that's free money.
I love that, Breanna. And I like to think about it this way, that when it comes to retirement contributions, it's basically a deduction that you get for paying yourself. You're taking money from your own money and you're putting it into another account. Now it's restricted and how you can access it, but it's still your money in a retirement account, and you get a deduction just for moving it over there. And that's virtually the only scenario where you can get a deduction like that for paying yourself. So with that, let's talk about another sometimes confusing item when it comes to our itemized deductions and the standard deduction. We hear a lot about charitable contributions and the tax benefits of giving to charitable organizations. Are we guaranteed to get a tax deduction for that?
No, well, yes and no. I mean, you shouldn't be making charitable donations for the tax benefit, right? Says that that's not really the intent of, what the contribution is. And it doesn't automatically mean you're going to get a benefit on your tax bill, because you have to itemize to use that. And there's a pretty, it's confusing. I mean, I think until I was really a CPA did I fully understand the difference between itemized deductions and standard deduction. So each year when you file your tax return, you're given a freebie, and enjoy that. Okay. So for your married filing joint returns, you get a freebie of $25,100. Now, when I say a freebie, it's a deduction off the top of your income. So if you make $100,000 joint, you can automatically shave off $25,100. Okay. And you're actually only going to be taxed on the $74,900. Math is good. Anyways, and for singles, you're looking at about half of that pretty much. So 12,550. And if you qualify for head of household, you're at 18,800 this year. So if your charitable donation and combination of your mortgage and your state taxes and potentially even medical payments that is accumulatively greater than those dollar amounts I just listed for your filing status, then you're going to get to take the benefit from making that donation to that charity, because in the end, you get the greater of the two. You get to deduct, whether the standard deduction's the greater, you get to take standard, and vice versa. So not automatically do you get a benefit tax-wise for making that charitable contribution. However, it can help you get, add to that itemized deduction count, and it could put you over the limit.
While we're on the topic of charitable donations, you can only take a tax benefit when it is to a 501c3 organization recognized by the IRS. If Haiti, I know, has been in the news with some natural disasters. If you donated to an organization based out of Haiti that does not have a 501c3 blessed by the IRS, you don't get a deduction. Now, if you give it to the Red Cross or some other US approved organization that also operates internationally, that would count. Another thing that we'll see is, business owners and employee has a death in the family. And so the owners will send flowers to their funeral or help pay a funeral cost. It is a charitable intent, but that recipient is a person. That person is not a 501c3. There is not a tax deduction for those. So it's important to remember that line in the sand. It has to be to an IRS approved organization to get the IRS approved impact on your tax return.
So Katherine, are you saying those GoFundMe donations don't count?
It depends who it's to. If it is to an animal rescue or some group like that who has their 501c3, it can be. If it's to, help support a family of a police officer who was wounded or something like that, and it's going just direct to an individual, it doesn't. So that has one of the most common answers we give people. It depends.
And good news for a lot of you guys, the taxpayers, those organizations already know the rules, and they typically disclose that up front. And because that's one of the ways they get you to donate. They actually say, oh, we're a 501c3 and you can write us off, so donate. So, a lot of the guessing game is pulled out of that. But on those GoFundMes, I will say on the 501c3s, I believe I've seen a lot of them put that information in the summary or the description of what the GoFundMe is about, so you kind of know ahead of time. But, unfortunately, especially coming off a pandemic where, we saw the death toll rise throughout the year, and, those GoFundMes were open, people lost their jobs, and, you have charitable intent and you're wanting to help out the betterment of the people of the country, those contributions don't count towards that limit.
Thanks, Breanna and Katherine. So speaking a little bit more on itemized deductions, what about the tax benefits of buying a house? Am I always going to get a tax benefit when I do that?
Again, it's part of the itemized deduction. It's an accumulation of those things. So, if your home interest is $6,000 and you donated $3,000 in the year to a charity, you're at $9,000 so far. And, depending on what your state taxes are, we'll just say, we'll use the max of $10,000. I mean, that's 10,000 plus the 9,000. You're at itemized deductions of 19,000. And if you're a married filing joint person, well, a standard deduction for 2021 is $25,100. So no, buying that house didn't automatically give you a tax write-off because the freebie is so high. Now, back in the day, pre-Trump era, when the freebie was lower, a lot more people got benefits from buying a house. So that's just a more recent change with the tax code, with the standard deduction going up so high. It's not as big of a benefit owning a house versus renting.
Now, there is one tax planning strategy that we'll sometimes use where you can take turns leapfrogging and get the best of both worlds. If you pay your own property taxes, you get the deduction for that in the year you write that check. So if you would have been at 19,000 for 2021, so you're not going to make it over and that freebie's better for you, wait and pay your property taxes January 1st of 22, and then also pay the next year's property taxes in December of 22. Or you could do the same thing with your charitable donations, or you're functionally doing 2 years worth in January and December. So you might get the freebie standard of 25,100 in 1 year. Then you stack everything in the next year to get 30,000. And then you go back to the freebie 25 the following year, and you can take turns kind of leapfrogging so that you do get credit overall if you can time it well between the years.
That's a great point. There is one thing you want to keep in mind when you're trying to do that tax planning tactic. State and local income tax deduction is capped at $10,000. So if your property tax bill every year is already $10,000 plus dollars, there's no reason to try to lump those in 1 year because you're going to be capped at $10,000. And in addition to that, for Texas doesn't have a state income tax, but somewhere like New Mexico or even California or any of those other state income tax states, the amount that is withheld out of your paycheck to cover your state income tax bill, that is also goes towards that $10,000 count. So just keep that in mind. 10,000, to be honest with you, it's currently a hot topic on both sides, Republican and also the Democrats. They would, some are looking to actually get rid of that limit because of various reasons, but it's kind of a low limit, and it definitely has hindered or impacted negatively taxpayers who typically itemize with those large state income tax payments. So on the home subject, we can probably go on and on and on about all the income tax benefits and not so much the benefits and so forth. But there's a pretty common myth about, when you sell your house, do you have to pay income tax on it? And if you don't have to do that, in order to avoid paying income tax on it, I have to buy another one right away. And, Judd, would you say that's true?
No, it's not true. So the rules around recognizing a taxable gain on your house are relatively straightforward right now. So you are able, if it's your primary residence and you sell your house for a taxable gain of less than $250,000 if you're single, or $500,000 if you're married, you don't have to recognize any taxable income on that sale. So that means that, if you if you, generally speaking, you buy a house for $300,000 and you're married, and 5 years later you sell it for twice that, say for $600,000, then that's a $300,000 gain, and that would be entirely excluded from your taxable income. There are some rules around how long you live there. Generally speaking, you need to live in the house for more than 2 years, and like I said too, it does need to be your primary residence. So you can't escape this through a vacation home or a second home of some sort like that. But it is a great tax benefit when it comes to selling your home, so that you don't have to pay tax on that, and you are not required to reinvest any of the proceeds into buying another home or real estate of any kind.
And if you have that vacation home and you call me or you call Judd or Katherine and you say, hey, can I make that my personal residence? Can we just switch the address on my return? I mean, the good answer is no. You know, what they'll do if you file that and you claim that exclusion on the sale of a vacation home or your second, a second home or whatnot, and they smell it to be fishy, what's going to happen in the event of an audit, they're actually going to ask for your utility bills and your bank records to see where you're constantly banking. I mean, they will actually see where's your digital footprint, where's your physical footprint, to confirm that that exclusion is available for you. So, don't think you're going to pull a fast one. They go back and they're going to ask for proof of residency and all of that jazz. So, if I'm in New Mexico and I have a second home in Texas and I want to say my home in Texas is, I want to claim that exclusion, but it really has always been my second resident. One of the things they're going to ask me is, where's your driver's license at? Okay, so it's a very intimate kind of question in the event of an audit, because if you think about it, a $300,000 gain typically is going to put typically it's going to be about 15% taxed for capital gains, but it could put some people into the 20% capital gains bracket. So it is really important that if you're thinking about selling your second home and it really is going to, you really want to substantiate that, you got to do some really proactive planning and really actually move there. So don't think you're going to pull a fast one on the IRS. You could, and then they can come find you. But
well, on that point, it's not just the IRS you've got to worry about. Texas, we don't have a state income tax, but lots of people in Texas may have a vacation home in Colorado or California or New York or somewhere that does have a state income tax. And I would say you have to sing the same song to everybody. If you're trying to say your Colorado property is your primary residence, that means you're a Colorado resident. That means you owe Colorado state income tax on all of your earnings. And that can very much make it where it's more detrimental overall than just leaving it as a vacation home. You pay that gain one time and stay in Texas where we don't have a state income tax. So those are decisions to really talk through and think through the whole impact and not just this one component.
And one last point to add on that, I mean, those who have homes out in California, I'm a California native, so I know that law pretty thoroughly at this point. And if you claim residency in the state of California to claim that exclusion, well, I'm sorry to break it to you, all your income, regardless of state source, is taxed at California's rates. And you get benefits, for only being taxed on your portion of income in certain states for when you're a non-resident. But a lot of states, when you're a resident, and in California specifically, they don't care where you earn it because they know their tax rate is one of the highest in the country. And so what they'll do is they'll only give you a credit for the amount of tax you paid to another state. So it opens up more cans of worms than you can even anticipate trying to flip over your residency just merely to avoid some tax. I mean, it's not really always worth it.
Thanks, Breanna and Katherine. Those are some great points, and good things to keep in mind when it comes to selling your house, something that most people at some point in time, at one time or another, are going to come across. Going back to something that sort of talking about earlier, we were talking about tax rates and given some examples using some really simplified tax rates. But as most people know, we have a graduated income tax system, which means that we have different tax brackets. It's something we hear about a lot. Which means that as your income goes up, your income gets taxed at a higher rate. But that can be a little bit confusing. Sometimes that even feels like that means that if I make more money, that all of my money is going to be taxed at a higher rate, and I might be even worse off than if I hadn't made that money at all. Is that how it works, Katherine?
It's not. And the best way I know to explain this is with a kind of a visual example. So we're going to use everybody's imaginations for a minute. If you picture a glass bottle with water in it, and you put drops of blue food coloring in it, it's going to be blue. And what some people believe is that if you made more money and you go to that next tax bracket, that adds a new color to the water and changes the color of the entire bottle. And that's not how our tax system works. The way our system works is if you were filling that bottle with colored sand, and some of you may remember going to fairs or craft shows and seeing these bottles with the rainbow stripes of sand inside of them. So you've got a glass bottle and you're going to pour in blue sand. That blue sand is your income for a joint taxpayer from 0 to about $20,000 of income is that blue layer sand, and you will pay 10% tax on that blue layer. So you make $20,000, you're going to have a 10% tax bill, and you're done. Now, say your income increases to $30,000. That next layer of sand is now green. And from about $20,000 to about $81,000, that green layer of sand is taxed at 12%. Now that blue sand didn't change. It's still there. That first $20,000 is still taxed at 10%. Only that new $10,000 of green sand is taxed at 12%. So you could make $5 million and you're still going to get that blue layer of 10%, that green layer of 12% until you get up to the top tax rate. And once you're at that top tax rate, then you stay that color until you get to your total income for the year. But those first layers don't change. So it is something to be aware of if you're going to get a big raise, if you're going to get a bonus, to know where those color changes occur, but know that it's only on that new level that you'll have that new rate. It doesn't reset back to your first dollar.
And some kind of general myth kind of going on right now, adding on to the tax brackets is, right now we have a new president administration. I mean, we have the Biden administration in office, and there's a lot of rumors going on right now about tax law changes coming down the pipeline. And probably the most notable one, that's drawing a lot of attention is the fact that he has proposed, it's not set in stone, increasing that top rate from 37% to 39.6%. And, as Katherine's saying, not all your income is going to be taxed at that. And many people actually don't even reach the 37% bracket currently today. So just a little food for thought, that is only going to impact anyone who really earns more than $523,000 a year. And if you get a little bit more of a break, if you file a joint return, it really won't impact those joint filers until they earn over $628,000 a year. So I like to bring that up because there is misconception on how the tax brackets work. And when they start talking about bumping up rates, keep in mind, it's not a blanket bump up, and there's different levels to it. Now, when Trump did come into office, he did decrease the rates amongst different brackets. And so, right now, all the rumors we've heard so far, they've only been talking about changing the highest bracket. I mean, no one knows what's actually going to come out of, the administration or Congress, but I did want to kind of add that because I've been asked a lot of times about the increase in tax rates.
And one more item I'll put there is when you hear the media or Congress talking about, well, this is only going to impact the top 10% of earners, the IRS actually publishes statistics once they get all the tax returns for the year to say, this is how much money you have to make to be the top 10% or to be the top 1%. And for the 2018 tax returns that were all filed in 2019, top 10% of income is $151,935, which if you're a husband, wife, both working a job, $151,000 is not that high, especially in certain parts of the country. The top 1%, again, this is for the 2018 year, is $540,000. So when they say, oh, it's only going to increase on the top 10%, that may hit a lot closer to home than you expect it to because of how the income's allocated throughout the country. And there's a whole other topic and side discussion that can happen on income allocations. But if they're talking about a tax impact to top 10% and your household makes more than $150,000 a year, your radar should go off because that's probably going to impact you in some way.
Those are great points. Thanks, Breanna and Katherine. And one thing that I would add to that too is if you are one to sort of follow the debate in Washington and what they're doing with the tax law, something to keep in mind is one way to increase or decrease taxes is to change where those brackets begin and end. So you can leave the rates the same, but if you lower where the bracket starts or where it ends, then you can impact what the real tax is that individuals are paying. And that was something that we saw with the Trump tax law too, was that the rates decreased, but there were also some pretty significant changes in where those brackets began and ended that also had a pretty significant impact in some cases in decreasing tax rates for some people because of that, the way that sand bottle tax works, the way Katherine described it. That was great. So shifting gears a little bit, we're recording this in August. We're in the CPA world, tax world. We're getting ready for our fall tax deadlines when all of those returns that were extended from earlier in the year are going to come due. And so one thing that comes up when we talk about extensions is the idea that filing an extension is going to delay when I have to pay the bill. Is that how that works, Breanna?
Man, I wish. I so wish, because I wouldn't pay until October 15th either. No, and you guys, if you ever were curious and if you don't believe us, if you get on the IRS website, they actually have it in bold letters. An extension is a time to file, but not to pay. There are underpayment late filing penalties and interest for every month that you wait to pay that after the 4/15 deadline. So again, no, I'm sure I can speak on behalf of the rest of America. I wish we had until October 15th, but that's just not how it works.
Well, while on the topic of extensions, let's talk about whether that is going to increase your audit risk.
Yeah, I don't know where this one started because no, it's actually kind of the opposite. If you file an extension, you're not really going to increase your audit risk. And I'm not saying if you file an extension, you're decreasing your audit risk. Okay, there's no proof in either or. The only thing I can confidently say is the fact that the IRS has announced, and stats, as Katherine's noted, they post stats and we all look at the stats. Most fraudulent returns are actually filed at the beginning of season. And the reason behind that is, well, identity theft, you can only electronically file a tax return with that social one time. So if if someone stole your identity and you go file a return after them, their IRS, their system's going to reject that return because someone's already filed. So most fraudulent returns occur at the beginning of season, and that's actually why you'll see refunds take a little bit longer, especially the ones with earned income tax credits. They really kind of wait to see if any duplicate returns are going to show up, or also spouses, ex-spouses that have experienced divorces. Sometimes they'll race to file first to claim the kids because they're divorced, and you have to put the kid's social on that return, and only one ex party can claim the kids for those child tax credits. So no, filing extension doesn't increase your audit risk. I'm not also saying it decreases your audit risk. Your audit risk is your audit risk, okay? And there is no, they don't tell us that. They're not like, oh, well, if you wait until October 15th, we've already pulled from the pool for the year, so you good. No, that's not how it works. But definitely at the very beginning, they do process things a little bit slower with the pure fact that that's when most fraud occurs.
And I'll also add on, if you get a letter from the IRS that you have been selected for audit, strongly recommend do not try to do it yourself. If you're in the room or you're talking to the IRS agent and they ask you a question, you don't have an out because it's you. When our clients do, I call it lose the lottery. When they lose the lottery and get picked for audit for whatever reason, they have us represent them. Our client never actually talks to the IRS. We correspond in the middle, which means that the agent says, hey, do they have, vacation homes in other areas or something like that? We can truly say, not that I'm aware of, but I could ask. And lots of times the IRS will drop the question because they're fishing. They're trying to see, is there anything else going on? But you as the taxpayer, you can't put in that stall or that time differential. So an audit is really something I advise do not try to do yourself. There's a lot of traps, there's a lot of tricks, and it can be well worth having a professional represent you and try to get any audit changes as small as possible.
Thanks, Katherine and Breanna. Speaking of audits, that's something that none of us really want to have to face if we don't have to. And so sometimes I hear people shy away from taking deductions because they don't want to have to face an audit. So what do you say to somebody that's concerned that taking certain deductions are going to be a red flag or a loophole and is going to make it likely that they're going to get audited? Breanna?
Well, first off, if it's valid, it's valid. Regardless if it's going to result on a loss on your actual tax return, as long as it's valid and it's valid, and in the event of an audit, you have support to back that deduction, then you shouldn't be afraid of taking it. Depreciation is probably one of the more lucrative deductions, considering you can finance a piece of equipment and get the full write-off of that piece of equipment the year that you actually financed it. So you can, finance a $100,000 piece of equipment, and even though you haven't paid $100,000 in cash, you get to write off all $100,000 of that piece of equipment this year. So, don't shy away from real viable deductions. Even, you got telephone expenses when you're self-employed. You're on the call all the time. Oftentimes we'll have clients, not put their telephone expense because they're afraid of having to back that up. We live in a digital world. I don't know very many people who can operate a business without paying for a telephone. As long as it's ordinary and necessary for conducting your business, you are more than welcomed to take that deduction. In fact, obviously the government wants to collect as much tax to fund their programs, but they're also doing that for the benefit of the people. So if you're taking valid deductions, well, you're still a person of this country, and they don't want you to be overpaying tax either. So, keep that in mind when you're making those decisions on, whether I should take this deduction or not. If it's ordinary and necessary for your business, take it and really accurately show what your income was for that year for that business. I will say I do want to throw this out there, and this is a planning tip in some way. Those little multi-level marketing companies and whatnot, oftentimes those are scrutinized as a hobby. Okay. So if there's no real intent of making money and running a true business, and, when you're doing those multi-level marketing, or even if you just, I don't know, you're just doing some side work for someone, if you're not really intending to make money from that thing, and you're showing consecutive years of loss and loss and loss and loss, just because it's offsetting some of your other income, well, that can be a red flag. And consecutive years of losses to offset ordinary income, what's going to happen is they'll want you to prove that you had intent to make profit and that was really a trade or business. And why that is so critical is because hobby income, you still have to report it. So if someone pays you for this cabinet, you built them, but it's not really a full-fledged business, you just do one a year, and you build them and they pay you, let's say $1,000. Well, that $1,000 is included on your income tax return, but the expenses to build that cabinet, they are not. They do not get, they don't get to offset that income. So keep that in mind, on those smaller little multi-level marketing type of businesses. And when you're trying to claim them as a business, and not saying that you don't intend when the first year to get into them for profit, but it gets usually about year 5 when they start to say, man, you're taking $10,000 every year as a deduction to offset your wages. Is this really a business? And so that could potentially, that is a red flag. But when you have a rancher, someone who does ag, it's not unnormal for someone in ag to have year and year and year after loss. That's an industry heavily funded by debt, and an industry that has equipment that you can take those substantial deductions to offset current year revenue. So again, if it's valid and it's for the operations and it's ordinary and necessary and there's a profit intent involved, then you're fine. But if you're not really sure, and it's usually on the smaller level of, I say multi-level marketing because that's usually where I see it. And really to have that conversation with the client, what is your true intent here? And that is where, circling back to one of our first points, the benefit of having a CPA and having those conversations up at the front end versus paying the penalties and fines. A $10,000 deduction, and you get audited 4 years from now and they deem that really you took $20,000 of expenses to offset $10,000 of income. Well, they're gonna not only get the tax, but they're also going to charge penalty and interest from the date that amount was due. So if it's 3 years from now, that adds up fairly quick. So I do want to kind of point that out.
Thanks, Breanna. Those are some good insights, and I was thinking the same thing, that it kind of circles back to the beginning when we were talking about the value of having a CPA. And one of the ways I think that we provide value to our clients is making sure that for those deductions that they are eligible to take, that we have the support put together to be able to support those deductions when we file the return, and we can help make sure both that you're getting all of the deductions that are due, and also provide the peace of mind that the support is there should it ever be questioned, that the IRS isn't going to come back and nail you in a couple of years. And so that's something that is really important to have lined up on the front end, and make sure that you're really only paying the tax that you need to be paying.
I do want to say one thing. This is kind of a semi off topic, but it's kind of funny. In case, a senator or congressperson, if you're listening out there, we are the middleman for them. And really that's what comes down to. When you're paying a CPA, it is our responsibility to educate you on what's allowed and not allowed. And the rules keep getting more and more complicated as time goes. So I keep making the joke, we should be put on that defined benefit plan for life, retirement options. And anyways, but really it is our responsibility to stay current on those things. And it really is valuable to know those things ahead of time versus pay for it down the road.
Well, and one thing you mentioned there, Breanna, talking about multi-level marketing and some, when you've got sort of a side business and maybe it's a side business that turns into a full business, and so you're self-employed, you're not on the payroll somewhere else, or maybe for somebody that's been on the payroll somewhere else and has decided that they'd rather be their own boss. There's some differences in how they're taxed when you go that route, and some confusion certainly that comes up around that. So, Katherine, can you talk about what may be a myth for some people, that because I'm self-employed, I don't pay payroll taxes?
Yeah, there's a lot of differences between if you're paid with a W-2 or if you're paid self-employed, which is usually a contractor and you're receiving a 1099. I know there's been a big growth the last few years in what they call the gig economy, delivery drivers, Ubers, Lyfts, those type things. As restaurants and other industries were just hammered with the pandemic. There were people scrambling to find a paycheck to help pay their bills anywhere they could. So a lot of people, for various reasons, can change between these two structures. So most people receive a W-2 paycheck from their employer. And you probably all remember that first paycheck you got, or you look at the envelope and you see all those taxes they took out, and your net is a whole lot smaller than you thought it was going to be. And it kind of busts your bubble. There's three big things that come out of your paycheck. One is income tax withholding, or it'll be federal income tax, or FIT is the abbreviation on your pay stub. Then there's Social Security tax that's withheld, and there's Medicare tax that's withheld. And then you get the net after those items. What most people aren't aware of is behind the scenes, your employer, the company you work for, they also have to match that Social Security and that Medicare that's withheld from your check. So if there's $10 of Social Security and $3 of Medicare that are withheld from your check, that's $13 total. Your employer is sending $26 to the government. They're sending the $13 they took out of your check, and then they're sending the employer side, which is another $13, which gets to the $26 total. When you're self-employed, when you have a Schedule C, when you receive a 1099, if you get paid for something at a straight rate that has no tax withheld on it, at the end of the year, you will still owe the income tax, which gets back to the sand bottle bracket examples we talked about earlier. You will also owe Social Security. You will also owe Medicare. Those are commonly called the quote payroll taxes. But now you owe both sides. You are the employer and the employee. So if you got $100 as a W-2 worker, minus your $13 of Social Security and Medicare, you have $87 in your bank account after taxes. You get that same $100 as a contractor, you now have to pay the $13 employee and the $13 employer. And that means your net income after taxes is only $74 in your bank account. This is a big part of why if you hire a contractor to do something, the rates will be higher as they're grossing up to cover this tax bill. So when you have a W-2, your taxes are taken out every paycheck. They show up on your W-2 for here's the total withheld, and that gets credited to your account. You claim it on your tax return, and then you see if you have a refund or an overpayment. If you're self-employed, to avoid any penalties or interest, the government wants you to pay that in quarterly throughout the year. And this is where a CPA advisor can help you calculate what that amount needs to be. so that you're not paying penalties for paying it late, but you're also not volunteering cash to the government above what's needed. If you're just starting out in a new business, kind of a good general rule of thumb I give people is whatever you're getting paid as a contractor, as a self-employed person, take 30% and plan to pay it in taxes. The Social Security and Medicare employee and employer together is 15.3%. Income tax rates, the bottom two are 10 and 12. So if you round that to 15 to give you some cushion, that's where that 30% is coming from. If you're a lower income person, maybe you do 20 or 25. But that's a general rule of thumb to set some cash aside, especially if it's your first year.
I will say, again, it's the main difference too is that self-employment tax is coming off the net. So if you're, you get to take the expenses to offset that gross first, and it's the net number that you have to pay self-employment tax on. So I just wanted to make sure that's hit. And also, one thing I mentioned previously is continuous losses and whatnot, and that can be scrutinized and all of that fun stuff. Especially more than ever, but in the pandemic year, the gig economy and whatnot, Uber drivers and Uber Eats drivers, those food delivery services and whatnot, people shifted gears to replenish income by doing that, by delivering food to people for money. And a lot of times those businesses, so to speak, because you're an independent contractor and under a lot of those programs, you are engaged with the intent to make money. But when you actually get to filing your return, they end up in a loss. And a lot of times that's because of mileage. Okay. So, that's something to kind of keep in mind. That's not a hobby. That's not something you got to get worried about if you have a couple, multiple years of losses and it's, you're a delivery driver and you have all the mileage logs to back everything up. Those are bona fide deductions and you won't have to pay payroll taxes. If you end up in a loss, there's no self-employment tax. And if you have no other earnings, there's no income tax either. So, that's sometimes it's a great cash getter, but not necessarily, does it really make you money, but it helps pay the bills.
Those are great things to think about, especially in this time when alternative employment and different things with the economy. And we have a lot of people doing sort of their own thing and looking for different ways to make money. The tax impacts of that is something to keep in mind. One area where we get questions a lot is when someone passes away, how do we handle the financial items that they leave behind? One question that may come up is if I inherit something from someone who's passed away, do I have to pay tax on that? Katherine, how would you answer that?
So this is another area where it does depend what it is you are inheriting. If you are receiving cash, car, house, household items, clothing, jewelry, furniture, those inheritance items are not taxable. And under current law, you also get what's called a step up in basis. What that means is, say your grandmother bought her house 40 years ago and she paid $50,000 for it. And now she's passed away, it's worth $300,000, that over those decades, it's appreciated substantially. When you receive it as inheritance, it steps up to the value at the time she passed, which means it now has a basis or a worth of $300,000. You contact a realtor, they spend a few months getting it sold, you sell it for $300,000. That is now a tax-free gain because your sale price and your cost basis after that step up are the same number. So when you've heard about, they've talked in Congress about possibly removing or getting away with the step up in basis, that would be a very big detriment to a lot of people of all income levels. So there's a lot of pushback to leave that alone. But it's always something to keep in mind. As far as the value at the date of death, it can be pretty close to when the person passed, or you could set it to be 9 months after the date that they passed. If there's brokerage investments, if they've got rental property producing income, how you value different assets can vary. So this is an area, again, to talk to a CPA about what your specific situation is, what the person who's passed away possessed. When talking about inheritance, one thing I'll put out there is a lot of people use trust, especially if there's children or grandchildren of young ages who are going to be receiving anything. If there's a trust involved, the phrase I use is, here be dragons. The trust rules and tax impacts and tax rates and what can and can't happen and who can do it get very, very complex very fast. You absolutely need to talk to both an attorney and a CPA if there's a trust involved. It's a legal document. There's legal rules you have to follow that attorneys can help explain. And then there's income tax impacts both to the trust and to the beneficiaries of the trust that a CPA can help explain as well. So Breanna, why don't you talk about some times where inheritance can be taxable?
Right. Yeah. Well, there are some instances where it's not completely tax-free. That's for sure. One of those are IRAs that you're inheriting, any kind of like retirement account. Remember, those retirement funds typically have money in them that hasn't been taxed ever. And so you don't get to bypass ever paying tax on that money. I mean, they're going to get their share. There are some new rules associated with time lengths of how quickly you have to completely clear out that IRA, or whether you roll it into one of yours or so forth. I mean, this is, that I'm not going to get into the nitty gritty, but just know if you're inheriting an IRA or any kind of retirement account, and when you pull that money out, you're going to pay income tax on what you pulled out. I mean, there's really no exception to that. Okay. Now, another thing is if you inherit a trust, and this is not necessarily a trust that was just funded, because typically there's some step ups depending on the trust document and the estate plan. I mean, we can go on for hours about estate planning, but if there was already an existing trust and there were already beneficiaries in that trust drawing on those trust assets, and one of those beneficiaries, they pass and you're the next heir in line for that trust, that trust is probably going to be pushing out income to you. And what that means is there's also going to be a K-1 with income that you have to report on your personal income tax return. Okay. So typically assets that are held in a trust are still generating some form of value and portfolio income. So interest, dividends, and so forth. And to be honest with you, you don't want the trust to pay it, because the trust income tax brackets are really, really small. I don't know if you guys remember at the beginning, I had said the highest income tax bracket for an individual really starts around the $520,000 range. Well, for a trust, it starts at around $12,000. So definitely more advantageous to have that income flow to you than just to accumulate it at the trust level. I mean, the trust is going to pay more in tax, and that's not the intent. That's why the tax brackets are small in a trust. The intent is to not just accumulate earnings into a trust. It's to get it out to the beneficiaries. Okay. And again, like Katherine said, if you are now new to the trust world, or if someone has passed away in your life and they ultimately had a trust or assets put in a trust for your benefit, and maybe you're even named the trustee, and maybe you're the named trustee and you're not the beneficiary, do not take that role lightly. Because in the end of the day, if you misuse those assets, meaning pull out of that bank account and you were never entitled to it, those beneficiaries can come back and sue you, and you will have to pay back the trust. That is a legal binding document. So, that is not something every person on the street will ever experience in their life. And if it's a new world to you, I highly, highly, highly suggest seeking legal counsel and also a CPA, so you can get an understanding of what the tax implications are and what is their role and responsibility and what are their legal liabilities. And maybe that's not a role you feel comfortable with. And if it's not, usually in a trust document, there's some form where you can step down as a trustee and there's someone appointed after you. So don't take that role lightly. Just know that it is, it is a legal binding document, and potentially if you're on the other end and you're a beneficiary and you're getting money from the trust and it's from the trust and that trust is every year, that money is going to be somewhat taxed. Now, again, it's not necessarily if I got $100,000 from the trust, but the trust only earned that year $50,000 in income, I'm not paying tax on the $100,000. I'm actually only paying tax on 50, because the idea is I got the other $50,000 I got is trust corpus, meaning it's principal. It was part of the initial asset that was put in there. So it's not necessarily the dollars you actually receive. That's the max of income you can report, or you'll have to report on your personal income tax return. It's really limited to how much income did the trust actually earn for the year.
Thanks, Breanna. Those are other good things to think about. And boy, it feels like we're sort of scratching the surface on a lot of things. We could go on and on with estate planning and everything there. And really with everything that we've talked about today, just sort of there's a lot more to this, and a lot to think about when it comes to taxes, and that's why, like we said, it can be really helpful to have a CPA on your side to make sure that you're getting all of the benefits and not falling prey to some misunderstandings that may be out there about the tax law and how it really works. So I hope that this has been helpful for everyone today, that you've listened and maybe gotten something from this. We've enjoyed putting it together, certainly. Thanks to Breanna and Katherine for being here with me. And thanks again for listening. Follow us on social media, visit our website, whitleypenn.com. And just remember, when it comes to taxes and CPA and accounting, Whitley Penn is here for you. So please reach out to us and see if there's something that we can do to help you all. Thanks, everyone.